What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. In late 2021 and early 2022, a new crypto system called Terra was taking the world by storm. At the peak, its associated crypto coins had a combined market cap of over $60 billion. Unlike many other altcoins, it wasn't just retail investors and meme traders pumping up the price. Some of the biggest heavyweights in the institutional crypto space, including billionaire Mike Novogratz and the trading firm Jump Crypto, were investing billions of dollars into the project. It was run by a charismatic South Korean technologist called Do Kwon, who said that his project was already achieving mass adoption in Korea and will rapidly expand across the globe. Terra promised to revolutionize the global financial system by cutting out inefficient middlemen and making it seamless for people to transact with each other across national borders. To make matters even better, they offer a way for people to earn 18% yield on their stablecoins, which are pegged to the value of the US dollar. 18% returns with no risk. I haven't seen a deal this good since Bernard L. Madoff investment securities. As you might have suspected, this turned out to be a massive scam. In a matter of days, the price of Luna crashed from $100 to just 0.27 cents, for all practical purposes a 100% loss. This wiped out $40 billion of paper value. UST, the stablecoin backed by Luna, has fallen from its $1 peg down to just 20 cents at the time of recording this video. It also looks like it's on the way towards zero, wiping out another $20 billion. The epic collapse of such a high-profile crypto project, along with the 55% drawdown that we've seen in Bitcoin's price since its all-time highs, have caused many analysts to believe that we are headed towards the next multi-year crypto winter. Terra supposedly used a highly sophisticated and foolproof tokenomics system, such that UST could never diverge significantly from $1. So what went wrong? In this video, we'll look at what Terra promised to do, why it was destined to fail from the beginning, and why multiple billionaires fell for it. Founded in South Korea by Do Kwon, Terra was built on a mission to create a new financial system to replace both traditional fiat currencies and older cryptocurrencies like Bitcoin. In 2019, they launched their coins, along with a white paper explaining their functionality, which we've linked in the description below if you want to check it out yourself. There are two main components to the system, Terra and Luna, which are meant to represent the Earth and Moon. Terra is a stablecoin pegged to a fiat currency. In the case of UST, it is pegged to the US dollar. Luna is an auxiliary crypto coin meant to stabilize Terra's value. They call them Luna and Terra because the supporting cryptocurrency Luna stabilizes the stablecoin Terra, just like the moon stabilizes the tides on Earth's oceans. So what is a stablecoin? A stablecoin is a crypto coin that pegs its value to a fiat currency. The simplest way to peg the coin to the US dollar is to just buy a big stash of dollars to back up the value of the coin. You can freely redeem your coin for $1 US or pay $1 US to buy a coin. Because of this exchange mechanism, the price can never diverge from $1 for any significant amount of time. But Do Kwon didn't like this idea. If you have to hold a bunch of US dollars to back your stablecoin, you are still intertwined with the traditional financial system. He had a better system to make it completely decentralized. Luna would give price stability to the stablecoin UST. In exchange, people transacting in UST would pay a transaction fee of between 0.1% and 1% to the miners. To mine UST, you must own Luna, which provides the incentive for people to own Luna, thus supporting its price. Here's how it works. If UST is trading below $1, you can buy 1 UST and exchange it for $1 worth of Luna. If UST is trading above $1, you can buy $1 worth of Luna and exchange it for 1 UST. Therefore, if UST diverges from $1 in either direction, there will be an arbitrage opportunity. Traders will exploit this arbitrage until UST gets back to $1. Thus, in the long run, UST must always be $1, as that's the only stable equilibrium. When demand for UST is high, they sell UST to the marketplace and gain Luna in return. They burn a portion of this Luna to reduce the supply, which should increase the price of Luna. The remaining Luna is put into a treasury reserve, which will be used to fund what they call fiscal stimulus. People who own Luna can vote on various projects proposed by third-party developers. Their projects have the goal to increase adoption of Luna and Terra in the real economy. Approved projects will receive Luna to fund it. Based on the language that Do Kwon used in his white paper, he seemed to view himself as some kind of visionary. He talked about the Terra community adopting fiscal policies, similar to how a nation-state does. He positioned himself as the founder of a new decentralized nation that transcended the traditional financial system and government borders. These delusions of grandeur are common among many entrepreneurs, especially ones who overpromise and underdeliver. By this point, the Terra system looks a little weird. Why would you need one crypto to support another? But it doesn't look like a Ponzi scheme, at least not yet. Remember that if UST ever falls below $1, They must print $1 worth of Luna to give it to you. Let's say that Luna was trading at $100 per coin, which it was up until about a week ago. If someone wants to redeem 1 UST, they'll receive $1 worth of Luna, or 1/100th of a coin. On the other hand, if Luna is trading for 1/100th of a cent, which is about where it's trading now, you will need 10,000 Lunas to redeem 1 UST. Obviously, if the price of Luna is low, any redemption of UST will be extremely inflationary. Thus, Luna is very susceptible to Weimar Republic-style hyperinflation. Given the risks, why would anyone want to own Luna? This whole house of cards relies on demand for UST always increasing. This way, there will be upwards pressure on the UST price, so people will be buying more Luna to convert it into UST. And up until recently, this was successful. More and more investors wanted to own UST, and the market cap steadily increased from $180 million at the beginning of 2021 to $18 billion at the peak. So why did so many people want to get their hands on the UST stablecoin? The crux of the scheme revolves around the Anchor protocol, which they market as a simple way for ordinary investors to get instant, stable yields. In their marketing materials, they say that inflation is eating away people's savings and traditional banks only offer pitiful interest rates of about 0.5%. They are doing a great thing for the people by letting them finally get some significant yield on their hard-earned savings. The majority of UST is held in Anchor, which gives them a roughly 20% annual percentage yield. This UST is lent out to borrowers who post Luna or other cryptos as collateral. This doesn't sound too bad. It's like a bank. Some people lend money while other people borrow it. It makes sense that you would want to lend a stablecoin and collect a 20% interest rate. 20% returns with no risk. But why would anyone borrow at this rate? The reason is because Anchor gives them Anchor coins for borrowing. The value of the Anchor coins are worth more than the interest expense for borrowing. You're paying people both to lend and to borrow. So where does the money come from? Anchor takes the Luna posted by borrowers as collateral and puts it into liquidity pools to earn staking rewards. If the staking yields are high enough, they could theoretically make enough to pay the 20% interest rate to depositors. Many crypto traders did various financial engineering schemes, whereby they would lend and borrow Luna and UST and have an insanely leveraged position in UST. They deposit all of this money into Anchor and earn 20% yield on it. But they leverage it up massively to earn a much higher yield on their initial capital, in some cases more than 100% APY. To sustain this, they would have to own a huge amount of Luna as well. This only works so long as the price of Luna is increasing, or at least stable. If Luna dips, they'll be forced to liquidate, putting more selling pressure on the coin. Do Kwon and the other senior management team at Luna knew that this was a big risk. If people lose confidence in the system and the price goes down, Anchor won't have enough money to pay the 20% APY. As soon as they stop making these interest payments, there will no longer be any reason for anyone to put their UST in Anchor. They'll withdraw their money, sell their UST, and the entire system will collapse. To prevent this, they decided to make a war chest to prop up prices in the event of a panic. It's similar to how a central bank builds up reserves in foreign currencies to support their own currency. To do this, they raised a $1 billion emergency fund by printing more Luna. They used this money to buy Bitcoin. But who would give them $1 billion to the system that looks like a Ponzi scheme? As it turns out, there are some institutional investors who are unsophisticated enough to buy into such a crazy system. Mike Novogratz is a billionaire investor. He used to be a partner at Goldman Sachs and ran a hedge fund called Fortress Investments, which eventually failed. He then turned his attention to crypto and started a crypto company called Galaxy Digital. We're not sure exactly how much Galaxy Digital or Mike Novogratz invested in Luna, but it's probably a significant amount. Novogratz got a prominent arm tattoo saying Luna, referring to the cryptocurrency. Another large trading fund called Jump Crypto led the $1 billion funding round, which Terra used to make their emergency Bitcoin fund. Jump Crypto is a subsidiary of Jump Trading, a massive Chicago-based trading firm with 700 employees. This was less than 3 months before the project collapsed. Starting in the beginning of May, the crypto market started to crash as the Fed's rate hikes caused a general risk-off sentiment for both stocks and crypto. Crypto traders started closing their positions in Luna and UST to reduce their portfolio's risk and avoid margin calls. This created a death spiral where investors started redeeming UST to get Luna coins at the same time that other investors were already selling their Luna. As the Luna price went down, the redemptions became more and more inflationary, pushing the price down even more. Luna became so worthless that you would need hundreds, then thousands, then tens of thousands of Luna to redeem each UST at its $1 peg. At this point, UST fell below its $1 peg and currently sits at about 20 cents. At least theoretically, this shouldn't be possible. Shouldn't arbitrageurs be willing to buy UST for 20 cents and make a risk-free profit by selling it for $1 of Luna? Terra is now facing the same problem as Weimar Germany after World War I. They owed a lot of money to foreign creditors, which they didn't have enough money to pay. So they started printing trillions of marks, which they exchanged for foreign currencies to pay the foreign bonds. This works up until a point. But at some point, the currency brokers refused to work with them. With the mark declining in value so fast, even if they get 1 billion German marks per franc or dollar, by the time they try to spend it, it will already be worthless. So you wouldn't give 1 unit of a real currency even for 1 billion marks. UST is having the same problem. If you buy a UST and exchange it, you might get 10,000 lunas. Even if you try to sell the luna immediately, the price is declining so fast that by the time the trade settles, your luna may have fallen by another 50%. So you'll be hesitant to buy a UST even at a significant discount to its theoretical $1 value. Needless to say, all the investors suffered a total loss with their Luna coins, now worth just a tiny fraction of a penny per coin. To make matters even worse, Jump Crypto just had another disaster this past February. They lost $320 million when another crypto project they were involved in, called Wormhole, was hacked. After 2 catastrophic losses in the span of just half a year, Jump Crypto may be reaching the end of their road. It appears that these institutional investors did little to no due diligence before making their investments in Luna. Even beyond the fact that Terra's system was obviously unsustainable, just looking at founder Do Kwon's track record should have been enough to disqualify any investment. Before Terra, he created another algorithmic stablecoin called Basis Cash that functioned in a very similar way as UST. You might not be surprised to hear that it was also a complete disaster, and now trades for 0.74 cents each. At the end of the day, Terra was a Ponzi scheme that would fail sooner or later with almost 100% probability. It relied on more and more people buying into the coin. They lured investors in with a promise of 20% risk-free returns. They obfuscated it by shifting the money around in multiple different coins and protocols to make it more complicated. No matter how many white papers with fancy equations you write, you cannot make 20% risk-free returns. It just doesn't work. When the dust settled, investors in aggregate lost about $60 billion in paper value. Coincidentally, that number is very similar to the $65 billion lost by investors in Bernard L. Madoff investment securities. Alright guys, that wraps it up for this video. What do you think about Luna? Did it ever have any chance of working, or was it a scam from the beginning? Let us know in the comments section below. Before signing out, we want to share this gem with you. This is an interview with Luna founder Do Kwon just a couple weeks before his coin went to zero.
How many of these companies you think are entering the space just because it's hot and there's a lot of funding versus the ones that will still be here, you know, like 2 to 5 years later?
95% are going to die.
Yeah.
95% are going to die. Yeah. Yeah, there's also entertainment in watching companies die too.
There's entertainment. Oh man, that's so evil. At least you get to learn from it, right?